Preferred stock is a type of a security that is a little bit different than a common stock. You know that we call common stocks as shares. As such, preferred stocks are also sometimes called preference shares. But what is this preference thing? Where does the preference come from? Why is it preferred to anything else? It will become clearer to you once we take a look at some of the key characteristics of a preferred stock. First of all, it is a hybrid instrument. Hybrid, you may ask? Yes, hybrid, because it has characteristics of both debt and equity. That means a preferred stock has features of both bonds and stocks. First, let's take a look at some of the commonalities between a preferred stock and a common stock. First of all, there is no fixed maturity date. That means that it doesn't have a fixed expiration date. Second, two things about dividends. First of all, if you own a preferred stock, you can expect to get paid dividends. It is a fixed amount which is defined at the beginning when the preferred stocks are issued. But remember that it is not your right, as it is with debt. That means that you can expect to get paid these dividends. You're not guaranteed. So this is a commonality with stocks where there is no guarantee that dividends will be paid. If you recall, a company like Google has never paid dividends, but that is an exception. Most of the companies do pay dividends. The reason I bring up the Google example is that it is not an obligation for the company to pay dividends at all times. It depends on the company on a case-by-case basis. Similarly, for preferred stocks, as an investor, you can expect to get paid the dividends, but it is not fixed. It is not written in law. So if you don't get paid dividends, you cannot take the company to the court. Also, if the issuer of the preferred stock fails to pay interest coupons on the principal amount, it counts as a default that can lead to bankruptcy. This is the case with common bonds, but not in preferred stocks. So if you don't get paid the dividends, you have no recourse. You have made a bad investment. Another thing about dividends is more related to taxation. Dividends from stocks in most countries count towards taxes. You have to pay taxes on them. The same goes with preferred stocks. There is no tax deduction. This is in contrast with the bonds, because in the case of a bond, the interest comes from debt. You are being the creditor for the company. So you don't pay tax on that. That is a key difference. So once again, in the case of a bond coupon receipts, you don't pay taxes on them, but on a dividends from a preferred stock, you do pay tax. Now let's look at some of the similarities between a preferred stock and a bond. Well, first, the dividend amount is fixed. It is agreed upon at the start. It can be fixed as a dollar amount, say 15 cents per share, or a certain percentage of the par value, let's say 8% of the par value. Some preferred shares come with an extra flexibility of being convertible. This means that the owner of the preferred stock can choose to exchange them for the common stock or the shares of the company at a pre-agreed ratio. Say the ratio is 1:4 or 1/4. That means if you own 2,000 preferred shares of the company, you can exchange them for 500 common stocks or ordinary shares of the same company. Remember that I said earlier a preferred stock has no expiry date? Well, that is only partially accurate. Companies have multiple ways of forcing them to expire if they want. Common among them are two options. One is a call provision, just like a bond, where they can choose to buy back the shares at a pre-specified price or a ratio. Another one is a sinking fund provision, where the company sets aside a particular amount of money using which they can keep on retiring existing preference shares by using money from that fund on a periodic basis. These sinking funds are essentially asset reserves. They can consist of cash or bonds and are used to guarantee the buying back or repurchase of preferred stocks. Whether they're callable or not, the company is committed to buying them back and thereby retiring the preferred stocks. Valuation of preferred stocks. How do we value a preferred stock? We know that the value of any asset is the net present value of all expected future cash flows. Think of the structure of a preferred stock. It is a security or a financial asset with technically no expiry date. It only has one cash flow, which is expected to occur every year. So that is a perpetual annuity. In other words, a perpetuity. So that gives us the value as the ratio between the cash flow received and the rate of return required by the investors. So that is the annual dividend, because that's the only cash flow, divided by required rate of return for the investors. If you take a look at the example given to you on the screen, the company PG&E has a preferred stock that pays an annual dividend of $1.25, and the investors have a required rate of return of 5%. In that case, the value of that preferred stock would be the ratio of the dividend and the investor's required rate of return. So that gives us $1.25 over 5%. So $25.